Good morning, everyone, and thank you for joining us today. Apologies for the slight delay. We just had a couple of audio issues, which hopefully we've fixed now, but please let us know if you have or are having any connection issues, and we'll look to get that sorted straight away. But really today, I think it's really timely in terms of discussion with equity markets and really all markets experiencing a prolonged bout of volatility. So today, just talking about a bear market update. We've entered bear market territory. Equities are falling, rates are rising, but how should we be reacting to this news? And really, what does the macroeconomic picture look like at this point in time? So just before we get started, wanted to highlight that all information in this presentation is general in nature and does not constitute personal financial advice. If we can go to the next slide.
Next slide.
And all information in nature is general. Before we start, we are going to have an opportunity for questions at the end of the presentation. I'd encourage you please to use the toggle on your screen to ask a question at any time during the presentation, and we will absolutely get to all of them prior to the conclusion of the webinar, but after the session. And then just in general, I just wanted to highlight, I'm sure you're all aware of Bassanese Bias, David Bassanese's weekly publication, but we also produce a number of other regular content items which are really interesting and I think will help you in terms of an education piece on what is happening in the market at this point in time. And we also encourage you to follow us on our social channels and interact with us whenever possible. We're more than happy to take questions at any time, and we'll be happy to get back to you. But in order to kick off today, I just wanted to introduce our Chief Economist, David Bassanese, and give a little bit of an update on BetaShares itself. 73 different funds in the market at this point in time, over 21 billion in assets under management. And really, our objective in the market is to provide end investors with relevant, intelligent solutions that fit the Australian marketplace. So, as you said, 21 billion under management and growing, and options to play any part of the market, whether that's cash and fixed income, equities, currency, commodities. We feel that we have a solution for many different people out there. My guest today, our Chief Economist, really needs no introduction, but David Bassanese, who's been with the business for over 6 years now. He's responsible for developing economic insights in our portfolio construction strategies and certainly chairs our investment committee in terms of our model portfolios and products into the future. He's formerly a columnist at the Australian Financial Review and has held various economist positions through Bankers Trust, Macquarie, and the OECD. So welcoming Dave today and looking forward to having a robust discussion, David.
Thanks very much, Blair, and thank you all for joining us today in a bit of an impromptu webinar, sort of out of our usual sort of quarterly economic updates, but in view of the market volatility of late, we thought it opportune, as Blair mentioned, to provide you a bit more of a timely update to let you know what's going on and what the outlook is in terms of markets. And I'll go through it. Here's the agenda today. And as Blair mentioned, I'm going to talk for about half an hour, 40 minutes, but we'll have 10 to 15 minutes time after that for questions. So go through the economic situation at the moment, how that's played out in terms of interest rates and the exchange rate. Then we'll look at the share market and then some investment themes within markets at the end. So firstly, in terms of the economic update, and here's just a snapshot of what's been happening in terms of global markets. The top slide there is the MSCI All Country Equity Index, as it's called. So it's actually an aggregate of global equity markets around the world. You've got US 10-year bond yields. You've got the US dollar index, so the broad index of the US dollar against major currencies, including the Aussie dollar, and then a broad index of commodity prices. And so in summary, what you can see is we've had a nice rebound from COVID in terms of equity markets, though as of late last year, and associated through most of that period has been a rebound in interest rates. So US 10-year bond yields have been rising through 2020, 21. But now the rise since late last year has accelerated as central banks have moved closer to raising interest rates and actually started to aggressively raise rates. And so really what's happened is the acceleration in bond yields has finally taken its toll on the equity market. And so we've had equity markets sell off since the start of the year. And as we'll see a bit later, largely due to valuations coming down. So the so-called price to earnings valuations of the markets, which were pretty high. Again, coming out of COVID and helped by low interest rates for a while. Then as interest rates have gone up, it's put pressure on those PE valuations. So far, at least, earnings are holding up. But again, I guess the issue for markets as we go through this year is that the increase in rates and the likely further increase in rates by central banks may well take a toll on the economy and on corporate earnings. So that could be the next shoe to drop in terms of equity markets. And you see commodity prices have remained strong. Russia's invasion of Ukraine has added to the upward pressure on commodity prices. But again, as you can see there in the lower right corner, even before Russia invaded Ukraine, commodity prices have been rising. Food, energy, base metals, iron ore, on the back of the recovery of global markets, global economy from the COVID shutdowns. The aggressive interest rate increases also have seen the US dollar strengthen. So the aggressive interest rate increases, particularly in the United States, have seen the US dollar strengthen, which in turn has hurt the Aussie dollar so far this year, despite the strength in commodity prices. So at a snapshot, that's what's been happening. It's really been the bond market. So the lift in interest rates, which has hurt bond markets, has in turn hurt equity markets. So the correlation, often when equity markets weaken, you get economic weakness, which means central banks come to the party by cutting interest rates, and interest rates fall and bond markets rally. So you get this negative correlation between equities and bonds. But when it's the bond market selling off, hurting the equity market, that correlation turns positive, and that's unfortunately what we've seen so far this year. So if you're holding a portfolio of bonds and equities, you're going to find, unfortunately, that both bonds, the value of your bonds in your portfolio and the value of your equities have both fallen so far this year. So it's been a fairly painful period for investors with a diversified portfolio at the moment. Going forward, and I'll touch on this a bit later, if we do get signs of a growth slowdown, earnings will start to weaken, which may mean the equity markets will continue to remain under pressure, but the sell-off in bond yields and the sell-off in bonds may then have run its course. And so we may get the correlation between bonds and equities turning negative again, by which I mean equities continue to weaken potentially, but bonds stop weakening, bond values stop weakening, in fact, possibly start rallying if yields start to fall. So that's really been the snapshot of the global market situation, and really what's been driving this very sharp rebound in bond yields. You look there, US 10-year bond yields at the end of last year were around about 1.5%, and they've gone up over 3%, so a doubling in yields, and in turn, due to a very sharp acceleration in inflation around the world. So if you look at the first slide there, headline inflation in the US are now over 8%. Energy has been a factor, but if you look at the blue bars there, that's the so-called core prices excluding food and energy. Even core prices in the US have increased strongly over the past year. So it's not just an energy or a food story, it's somewhat more broader. And it is actually areas like rents, used car prices, hotel rates, a whole bunch of areas where the strength of demand coupled with supply chain limitations and just supply not being able to keep up with the strong rebound in demand has led to pretty broad-based pricing pressure in the US. In Europe, as you can see, core prices haven't increased as strongly, so more of the increase in inflation in Europe at least has been an energy story. But nonetheless, inflation is also quite a bit higher than they used to. What we've also seen globally is that consumer sentiment has taken a tumble around the world on the back of this high inflation. So we're seeing consumer spending actually remain pretty solid so far at least, but that hasn't, so consumer sentiment has slumped because inflation has picked up, but so far at least it hasn't hurt consumer spending. And in turn, haven't seen much signs of a slowing in the economy globally. And that's why markets and central banks have been happy to keep talking about raising interest rates, because again, so far at least, it hasn't had a big impact on economic growth. But once that does start to happen, and I think that decline in consumer confidence is a lead indicator of where we may be going there, that's when I think markets and central banks will start to limit how far they think they are going to need to raise interest rates in this environment. Causes of inflation. Look, there are a combination. It's not just supply, it's not just demand, it is a combination of the two. So I mentioned food, and so the Russia's invasion of Ukraine. Look, for those who've joined our webinars in the past, you'll be familiar with this story. Russia is one of the leading energy exporters in terms of oil and gas, and happens to be particularly important for Europe. So Russia, basically, I think felt emboldened in invading Ukraine, because it thought, Europe isn't going to do much because it desperately needs Russian oil and gas. And so, but what we found out is Europe has imposed tough sanctions. So far, it's avoided sanctions on oil and gas, but they're, inexorably moving down that path as well. Europe is desperately trying to find ways to avoid using Russian oil and gas going forward. But in turn, basically globally, by the rest of the world not wanting to use Russian oil and gas, while demand is still strong globally, it means they have to seek that demand elsewhere. So it's put pressure on non-Russian supplies of oil and gas, and in turn pushed up prices globally. So it's the sanctions and the refusal, I guess, legitimate refusal, not wanting to enrich Russia by taking their exports, has added to upward pressure on prices. And also true in the food area, because we're seeing even at the moment, a lot of hassle in terms of getting grain exports. Ukraine and Russia, to an extent, are major food producers. Ukraine, often seen as the breadbasket of Europe, but their supply of grain to the rest of the world has been severely disrupted by the war, which is adding to pricing pressures in the agricultural area. Also, climate change is a factor. If you look at the US, they're actually going through a drought, and La Nina conditions. It does tend to produce wet conditions in Australia. What happens in the US is it produces drought conditions. So agricultural output has been severely disrupted, which again has added to upward pressure on food prices. China lockdowns have also been disrupting production. Things like semiconductors, for example, which are produced in China, major components to many goods, particularly cars in the US. And so we're seeing a shortage of cars in the US due to the semiconductor shortage, which in turn is putting upward pressure on car prices, which in turn is feeding through to the CPI. But it is also true, supply wouldn't be as big an issue were it not that demand is quite strong as well. And just broadly speaking, the ongoing recovery from COVID, the reopening of economies, has led to a bounce back in demand. And through last year, a lot of it was goods. I mean, basically the shutdowns that we saw and the working from home trends that we saw in Europe and the United States increased demand for goods. It increased demand for home furnishings, increased demand for leisure, clothing, all manner of things. So it was a change in the nature of demand. And as we've reopened and started going back to our offices and factories, that demand has started to moderate, but demand for services has picked up. So things like travel, driving your car has picked up in the United States and Europe, which in turn has put upward pressure on energy prices. We're seeing it in hotel rates and airline rates as well in the US. They've just gone through the roof in the last couple of months. And again, we're seeing that in Australia. Everybody wants to travel all of a sudden, all at the same time, and there's capacity constraints in how many people can travel. And really, what this is pent-up demand. People not being able to travel, go out to restaurants, go to hotels, these sort of things. That pent-up demand is now being unleashed, and it's added to the pricing pressure. Now, central banks, I mean, you could say, oh, well, this is all going to wash out. Let's just sit back and let the prices eventually moderate. Central banks basically are concerned about the longer they let inflation stay high, and it's certainly stayed higher for longer than anticipated, at a time when unemployment rates around the world are very low and tight, and wages growth is picking up. They're very concerned about the risk of a wage price spiral developing. Inflation expectations have picked up. Workers in many countries have strong bargaining power, and so the ingredients for a wage price spiral, which can sustain inflation at higher levels for longer, are certainly in place. And that's why central banks have basically lost patience with the high level of inflation, saying, you know what, we've got to raise rates, we've got to slow down demand. I know we can't handle supply, but at least what we can do is operate on the demand side and reduce the demand pressures in areas where there is a limited supply, just to reduce the risk of this wage price spiral developing. And so that's the situation we're in at the moment. Central banks are raising rates, Reserve Bank is raising rates, the Fed, the European Central Bank is getting close to doing the same thing. Ideally with not a view of creating a recession, but it's hard to fine tune these things. And look, I think, and as I'll go through, I think the US probably, given the extent of tightening we're going to see by the Federal Reserve, it's going to more likely than not have a bit of a slowdown and negative growth and a recession, which historically means the equity market can probably fall somewhat further over the next few months in the US, as I'll get into. Australian growth looking just on the Australian economy, looking quite good. Economic growth this year, we're looking at something like 4% growth. December on December, so up until the end of this year, powered by consumer spending. Consumers are still, spending very well. Employment growth is very strong. Household savings rate, as you can see there, prior to where we were before COVID, is still very high. So households have an income buffer to spend if they want, which is going to help continue to underpin consumer spending through the course of this year. Business investment, housing investment, also quite strong. We're seeing upgrades to the business investment outlook. Growth is expected to slow down next year, so from a 4% pace this year, way back to a 2% pace next year. But that's back closer to a trend pace, and it's still consistent with unemployment remaining low. So really, the risks to our economy aren't homegrown at the moment. Yes, the RBA is raising rates, but I don't think the RBA is intent on causing a recession in Australia. I don't think it needs to or wants to cause a recession. It does want to gradually raise rates. The bigger risk is what may happen in the United States and the sort of what potential blowback we get if the US does go into recession. And as I mentioned, so these are forecasts from the Reserve Bank back in May. Broadly speaking, I don't think they will change that much. The RBA still got the unemployment rate heading lower, getting to 3.5% by the middle of next year. And wages growth are picking up gradually. So their wages forecast is, at the moment, the wage price index, the annual growth in wages on that measure is only 2.4%. The RBA see that accelerating to 3.5% by the end of next year, which is in line with the long run, having inflation around about 2.5% on average over time, allowing for productivity growth of about 1%. So 3.5 is actually, sort of Goldilocks pace of wage inflation, not too weak or not too hot and not too cold. It would be just right. But anyway, that's what the RBA is sort of forecasting at the moment for inflation over the course of the year. Inflation expected to rise further. I mean, Phil Lowe's giving a speech today, gave a television interview last week where he did say he expects headline inflation to maybe hit 7% now. These are forecasts from back in May where they had headline inflation hitting 6%. They've upgraded that to 7%. And look, it's a similar story to what we're seeing around the world. Energy prices are a major factor driving headline inflation, but even stripping out energy prices, if you look at trimmed mean inflation, we are seeing pricing pressure in many parts in many other areas of our market due to supply chain bottlenecks, also just due to the strength of consumer spending at the moment. Businesses are feeling an ability to raise prices because of the underlying strength of consumer spending. But the outlook is that as they raise rates and growth moderates next year back down to a 2% pace, we can get and oil prices stabilize and in fact maybe come back somewhat, we can get inflation coming back down again. What does this mean for interest rates? Look, this just shows you the first slide, the absolute 180-degree turn in terms of interest rate outlook. So that dotted line on the first slide there is the orange line is the RBA cash rate. And as you can see, they've already started to raise the rate. The dotted line is what the market expects that cash rate to do over the following 12 months. And as recently as middle of last year, the expectation was for no interest rate increase for over the coming year. Then the central bank, we got inflation picking up. The central RBA started to talk about rate rises, and the markets have turned on a dime and now aggressively pricing in aggressive interest rate increases, which has principally caused bond yields in Australia to go up. So if you look at that black line, the market at the moment is expecting the RBA cash rate to go up to as high as 4% by the end of next year. So it's very, very aggressive interest rate increases. Now, the market's been right in expecting the RBA to raise rates and bring forward the tightening, but I still think the markets are getting a little bit overexcited about how far interest rates will go. I think Australia would be well and truly in recession well before the RBA got the cash rate anywhere near 4%. I still don't see them going that far, so I think the markets are probably pricing in too much. And as we see signs of a slowdown emerge, particularly globally, we'll see interest rates come back somewhat, not a lot, but I at least think they'll come back a little and certainly stop rising in the way they have. Just on the second slide, you can see bonds versus cash. So that's an index of bond performance. If you own bonds either through one of our ETFs or in an actively managed bond fund, and versus cash, you can see as bond yields rise, the value of bonds weaken relative to cash, and we've seen that happen so far this year. The very sharp increase in bond yields has caused a major underperformance of bonds, and double-digit decline in bond returns, which is pretty unheard of. It's very exceptional to see this degree of weakness in bond markets, but it's also very exceptional to see the speed with which interest rates have lifted just in the past few months, as central banks have basically gone 180 degrees from saying we don't expect we're going to raise rates for a few years to saying, you know what, not only are we going to raise rates, we're going to raise them very aggressively, and we're going to bring forward those rate rises. Federal Reserve only recently raised rates 75 basis points last week, and the RBA, surprised the markets by raising rates by 50 points at its recent meeting. And just on that, I think the RBA seems on track to raise rates possibly by 50 points again at the next meeting. And again, going back to the markets today, would you believe, are pricing in the RBA raising rates at every meeting at the last 6 meetings of this year. There's 6 more policy meetings this year, and the markets are pricing in the RBA to raise rates by 50 points, twice the normal magnitude of interest rate changes at every meeting. To me, that just still seems way excessive. They may raise rates by 50 at the next meeting and possibly the meeting thereafter, but thereafter I think they will settle back to a quarter-point moves and may well pause for a while just to see the impact of the aggressive rate rises having on the economy. But anyway, the markets are anticipating 6 50 basis point moves over the remainder of the year. And something similar in the US as well, very aggressive interest rate increases. And you can see that here, just the rate rise. And as I said, I think there's probably arguably too much being priced in at the moment. The canary in the coal mine here will be the US, areas of the global economy very sensitive to interest rates. One area will be the US housing market. This is a chart of the 30-year fixed rate mortgage in the US. And as you can see, it's basically doubled over the past 6 months or so with the aggressive change in interest rate outlook. Now that is going to have an impact. We're already starting to see housing demand waver. I mean, we're seeing it in Australia as well with even the very early moves by the RBA. But I think house prices are going to start to weaken in the US. Housing construction is going to come down, and in turn, that's going to feed into consumer spending. And the way mortgage rates are going, we're potentially looking at, quite a notable correction in house prices, at least in the United States. And if this is just a slide in terms of Australia, this is a a broad measure of the average repayments that households make to buy a medium-priced home in Australia. And what we've done there is price in a rate rise to 4.3% in orange there for Sydney, and for Australia in the sort of tan line. And basically what it says is that housing affordability would get to the worst levels that it's been to at least since the early 1990s, back in the days where we had 17% mortgage rates. So that would, be a very, very negative impact on the housing market and on consumer spending. So that's essentially what the market's pricing in at the moment. And I just don't see the case for the RBA to need to be that aggressive. Given, again, at the moment, still relatively benign wages growth, and even the RBA's forecasts. Look, the RBA could be dead wrong. Their forecasts haven't been fantastic, but if wage inflation accelerates up to 4, 5, 6% with unemployment at sub 4%, then you may well get aggressive rate rises. You may well get the RBA wanting to send the economy much weaker, and if not having a recession, because it would be forced to conclude unemployment is too low for inflation to come back to the 2 to 3% band. But my base case is wages growth won't accelerate to that extent. I'm more in line with the RBA thinking, and as a result, I don't think we'll need to go into a sharp downturn. Different situation in the US, where wages growth is already running at very high levels, 4, 5, 6%. But in part, that was due to trying to get workers back into the workforce, because they all left the workforce, they all lost their jobs during COVID, and then there was a mad scramble to get workers, back working again. And but even in the US, we may see wages growth start to moderate somewhat now that workers have come back into the workforce. But anyway, the US is a different situation. Wages growth already quite strong, where it's not the case in Australia. Aussie dollar has come under pressure. These are various drivers of the Aussie. Look, I've had generally a negative view of the Aussie. I've never, my target had been around about 68 cents, principally on the back of weakness of iron ore prices and also strength of the US dollar, given the Fed was, going to be more aggressive in raising interest rates over the next 2 years than the RBA. What we've seen is that the US dollar has strengthened, and iron ore prices have been choppy, but they are basically still tending to weaken. So the combination of those factors have pushed the Aussie down. I think the Aussie is going to hover around this sort of low 70-cent range. And if we do get a deeper slowdown in the US and commodity prices start to weaken, it may well weaken further, potentially into the mid, even low 60-cent range, if we do get a hard landing for global growth. So I wouldn't be super positive on the Aussie dollar in this environment. Just in terms of the share market, so this is the chart of the US federal funds rate, the policy target rate. And what I've got there, again, the grey areas are US recessions. The tan, I'm not sure what color I'd describe that as, tan, areas where I maybe should come up with a different color going forward. But you can see the tan lines where you've had, cycles of aggressive interest rate increases by the Federal Reserve, which have then, not necessarily caused a recession, but have been associated with a recession, sometime thereafter. The orange dots have been periods where the Fed has raised rates and it hasn't caused a recession anytime soon. Now, I've also got an orange dot back there in 2018 prior to the COVID recession. You would say, well, and the reason I've coloured it orange is that, the recession that we saw in the US was very short, very sharp in 2020, but you couldn't really blame interest rates for it because the Fed did raise rates between 16 and 2018, but it backpedaled in 2019. And really what caused the recession was the shutdowns due to COVID. So I think it would be unfair to blame the Fed for that. But again, the examples, the hope here is that, 93, 83, in the mid 60s, you did have periods where the Fed raised rates. It didn't cause a recession. But to me, the question is, it's not really, can the Fed raise rates and not cause a recession? It's, can the Fed does the Fed want to cause a recession, or will it stand in the way if a recession starts to develop? And I think I've come to the view where I think inflation looks so entrenched in the US, and it is such a demand is such a big factor behind it that the Fed, you may well get a recession over the coming 12 months with the Fed raising rates. And so the Fed basically won't stop the economy going into recession. It may need to tolerate the economy going into recession to get inflation down. That may be the only way we can get it sustainably down. If the Fed didn't want a recession, it could avoid a recession. It could stop raising rates today and it could backpedal. So it's not a question of the Fed making a policy mistake. It's a question of, does the Fed feel the need to let the economy go into recession in order to get inflation down? That's the big question, and that's one I've been grappling with for the last few months. And as I said, I've basically concluded that I think that the economy is going to get weaker, may well go into recession. Well, you know, I actually do say the US will go into recession, engineered by the Fed, but the Fed won't backtail quickly, won't change course quickly, because that's probably what will be needed to get inflation down. Here's the drawdowns of the US market. So these are the declines in the US market going back to the early 60s. You can see the periods of recession in there. So generally speaking, recessions are associated with bear markets, so greater than 20% declines. So all the recessions there are in red. And you can see more often than not, you've had a greater than 20%. You know, the dot-com bubble, the GFC had declines of about 50%. COVID was about 35%. In the 70s, it was over 30 odd percent. Now the one, if you look at 1990 there, in fact, I haven't used my mouse yet, but I might. So 1990 was a period where you did have a recession. Market only declined by 20%. And I look back in history at that time, and earnings growth that held up pretty well over that period, and so it was a fairly mild recession, and earnings didn't decline. The PE ratio, the valuation certainly declined, but earnings held up. And so that, you know, if you're looking for hope, is we could get a recession, but maybe only something like the 1990s. But that was a very short, sharp downturn already. In fact, if we go to the next slide, I'll just so these are all the periods of greater than 20% declines in the market, or very near greater than 20% declines in the US market, and whether they had recessions or not. So there's 1990, it was off about 20%, but it took place over 3 months. So it was a very short, sharp downturn. This time around, you know, we're already down as of 16th of June, down about 24%, and it's been going for 5 months. So it's already a bit longer than 1990. But look, I guess, look, my base case is the average decline during a recession over this period has been about, you know, almost 40%. My base case is the US, all said and done, may well decline by about 35%. And that's because earnings are probably going to need to come down. Earnings expectations are still too high in the United States. PE ratios have come down, but they could come down further also if you go into a recession. In fact, I'll just show you so this is the US market here. You can see the PE ratio has gone from over 20 times earnings, now down to around about 16 times earnings. During the sell-off, the panic of 2018, it did get down to 14.3, and obviously in periods of recessions in the past, it can get down to at least 14 and possibly into the 10 to 12 zone as basically fear overtakes greed. So I don't think even the PE ratio at today's levels is pricing in the fear that usually comes when the US tumbles into recession. That's point one. Point two is the earnings expectations. So these are analyst expectations for earnings for 22, 23, and 24. And you can see analysts are still expecting earnings in 2023 to be well above their level in 22, and similarly for 24. But if recession does take hold, I think these earnings will need to get downgraded. In fact, so forward earnings, rather than continue to rise, may flatten off and may weaken. I mean, this is what happened during COVID, and this is what happened during the GFC a decade ago. So you do get a period of declining earnings. Yeah, well, apart from 1990, which is the one exception, generally, you know, you'd have to imagine, you know, it's more likely than not you're going to get a weakness of earnings. So the combination of further declines in the PE ratio and a downgrade to the earnings outlook can get this the market weakening somewhat further. And I've penciled in some numbers here. As I said, at the moment the market's expecting 9% growth in earnings. 14, a little bit lower by June 23. So that's just some, some sort of, some projections, assuming the US does go into recession. Now I've done something that means I can't move this. Oh, yes, I can. Australian market. Look, I focus a lot on the US when I talk about the broad direction in equity markets, simply because when the US sneezes, we catch cold. So we can have the greatest fundamentals in the world in terms of the equity market, but if the US has a recession and a bear market, we're going to probably weaken as well. We may not weaken as much, but the market is probably still going to weaken, and we're starting to see that already. The market held up pretty well. Held up. I mean, it outperformed in the first quarter. These are quarterly numbers. So the market did drop in the March quarter. It actually held up in the March quarter. But so far in Q2, the June quarter, you've had the market start to come off as it's caught up with the sell-off we've seen globally. Price PE ratio is actually quite cheap in the Australia now. It's down around about 13 times earnings, partly because we've had a big upgrade to the earnings outlook because of the strength of commodity prices. But at the moment, the market is anticipating commodity prices are going to weaken, and so forward earnings going forward aren't going to be as strong. They may, in fact, the markets are expecting forward earnings to fall a little bit over the course of the next year. So we're not going to get much earnings growth in our market. But basically, the story here is, our market is starting to catch up with the sell-off that we're seeing globally. The period of underperformance of Australia has leveled out. So you can see relative to the rest of the world, we've stopped underperforming at least. We had a bit of an outperformance in Q1, but in Q2 so far, we've sort of, been more level pegging with the markets. But again, the bigger picture here is what's happening in the US, and that's going to potentially weaken our market as well. Sorry, I should talk, just before I go back to this, I should go back to this slide just to tell you, just to analyze, bear markets during recession. So just in the interest, so on average, bear markets, when the US market declines by more than 20% on a daily close basis, it's averaged a total fall of about just over 30%. When it's in recession, it tends to be not that deep, at about 25%. But when it's in recession, it has been deeper, around about 40% on these numbers going back to 1961. And the average period of decline is just over 16 months, so almost a year and a half is the average decline. So that's sort of what a recessionary bear market. So you can get so-called bear market rallies, and so nothing falls in a straight line. So you can go several months where the market rebounds, on hopes that the worst is over, but then the economy weakens, earnings get downgraded, and you get another leg down. So these things are a process that can play out over time. So just from an historical point of view, you can see that the bear markets in a recession tend to be worse than those that aren't associated with recession. So you've had, of the 12 periods, the 12 periods where we have had greater than 20% decline, seven of those have happened during recessions. 5 have happened outside of recessions, and I've got the examples here. But those tend to be, basically, if you think the US isn't going to be in recession, then we're near the bottom. I mean, this is a buying opportunity, and because it's fallen on average by what you would expect, and we're close to we're a little bit longer than the average time period in which the downturn happens as well. So again, if you think the US is going to avoid a recession and we're going to have a soft landing, then the market's off just over 20%. This is a buying opportunity. My only caution at the moment is I think recession risks are still somewhat more material in the US. Just on investment themes, I'll run through. Usually, as is typical, I've sort of gone a little bit over time. I do have a few minutes left, so I do want to dwell on some of the investment ideas here, just to let you know what's out there in terms of ways to play this market. So first and foremost, again, this is a defensive type of environment. Again, my base case is the US is going to go into recession. Market's going to go a little bit lower, well, up to 10 to 15% lower in case of the US market over the next few months. And so it's a time of caution. Not necessarily, that's, I guess the best I can say, it's a time of caution. So if you, have idle cash and you want to be defensive, one area is cash. You can invest in our AAA ETF. So again, that's just an ETF that keeps your money in your share trading account, but it's parked in basically bank deposits on your behalf. And that's now yielding about 1%, just over 1% after fees. So used to yield, close to zero, but with the increase in the RBA cash rate and expectations of further rates, the yields available on at-call deposits and bank and term deposits have lifted a little bit. So that's offering now a yield a little bit 1%. In fact, you see it there, about 1%. We do have a bunch of other fixed income funds, and again, as I said before, I think we're close to the peak pessimism in terms of interest rates. So long duration bonds, which have been absolutely smashed, to be honest, that's, if you held bonds, you've launched a historically unusual period of pain, something like double-digit declines. But I guess the bright side of that now is that they are now offering attractive yields. So if you want to buy into the market, you can buy something like our long duration corporate bond ETF with a prospective 1-year income return of just over 6% net of fees. So that's an indication of the sort of value you can now get in the markets. Our Oz bond, which is a composite index, it covers both Australian government bonds and corporate bonds, are yielding almost 5%. Hybrids used to be quite attractive relative to fixed rate bonds because yields were so low, but now they're not offering as much. And the other thing about hybrids is if we do go into a equity downturn or further downturn and credit spreads widen, they tend to get somewhat hurt. They don't get hurt when bond yields go up because they're floating rate exposures, but they do get hurt in terms of price return when credit spreads widen. So they are a little bit vulnerable to that. Cred is also vulnerable to credit spreads widening because it's a corporate bond, but offset by that is if you do get economic weakness, then bond, the degree of policy tightening you'd expect from central banks may come back somewhat, so bond yields may actually fall. So the duration component of that can help provide an offset in a way that it doesn't help in terms of hybrids. But anyway, there are a bunch of different income offerings that we offer through our ETFs. A lot more information available on our website there. If you wanted to be defensive, like just in the fullness of information, we have the Bear Fund, which are designed to move in opposite to what the market does. So basically, this is a fund that sells equity futures on your behalf. So it creates a short position in the market so that if the market goes down, the value of this fund goes up. And it's like a, broadly speaking, one-for-one relationship over time. We do have a strong bear fund as well, which gives you more amplified exposure to the market. This one, if the market declines by 10%, it will go up by 20 to 25%, and vice versa. If the market increases by 10%, it will come back by 20 to 25%. So people use these funds in two ways: A, just to take a bet on the market declining, or to you have long-term portfolio holdings. You don't necessarily want to sell your shares, but you do want to hedge some of your exposure. Then you can use a part of your capital to invest in the bear funds. That way, if the paper value of your portfolio goes down as the equities sell off, at least you're making up for that by some gains on the bear fund. But again, it does work in the opposite as well. If the market does rebound, the paper value of your shares will go up, but the value of your bear fund will go down. It's going to provide an offset. So these are not for everyone. I'd emphasize it's just for the sake of information to let you know that they are available. They are trickier, to play. Trying to short the market through bear funds does involve, extra risks and extra level of expertise. So I do provide those cautions. But again, in the interest of full information, I just thought I should share the availability of those funds with you. In terms of global thematics, again, at the moment, what themes are at the moment, this is about what is going to fall by the least. If the equity markets continue to weaken, then all parts of the equity market are going to remain under pressure. But what we have seen today is that value, you can see that value growth has been underperforming value of late with the rise in bond yields. So things like commodities have been doing well, things like technology doing not so well. I would just caution that if the US does go into recession and commodity prices start to weaken, you may start to see value no longer outperform. And in fact, growth may start to outperform. Some of the areas that have been hurt by bond yields going up may at least stop underperforming if bond yields sort of peak out and maybe come back a little bit. So that's just the main focus I wanted to point out there. Just be wary of piling into value and commodity at this environment, because central banks, yes, inflation is high, but central banks are acting aggressively to try to get inflation down, even at the risk of slowing economic growth. Here are a bunch of our commodity exposures, which have been doing very, very well. So fuel, again, in previous webinars earlier this year, I was advocating fuel, food producers, resource companies. They've all done pretty well. So, I mean, that call when Russia invaded Ukraine at the start of the year has been correct. Value has been outperforming. But again, I would just caution at this point that, you know, if the next leg is now weakness, you may see those no longer outperforming in a strong way. Technology exposures, again, they've been all hard hit. We've had we have a range of tech exposures that have been very hard hit. Still, look, no obvious light at the end of the tunnel in terms of outright performance. All I would say, and again, this is relative performance to global markets. So things like cloud computing, robotics, I mean, these are great long-term growth stories, but they have tended to trade at high PE valuations, and so they've been vulnerable to the rise in interest rates. But again, just to repeat, if we're near the top in terms of interest rate long-term bond yields, then we may be near the bottom in terms of the relative underperformance of these growth exposures. And when we come out the other side and you know, the US recovers and the Fed actually goes into reverse and starts cutting interest rates a bit, you know, these things I think will take off you know, very, very strongly. And you can see here Nasdaq, the relative performance of Nasdaq here in orange. It's underperformed as well on the back of rising bond yields. Financials haven't done as well as you would have expected given the lift in bond yields. Usually they do well, but BNKS is global banks, hasn't done as well as you would expect. And again, due to fear of global growth slowdown already, the market's anticipating that, and concerns about European banks and their exposure to Russia is a sort of you know, one of the factors that seem to be attributing to that. Defensive areas of the market, which you know, drug is doing well. So drug is global healthcare companies. So as a defensive exposure, that's one that is looking good at the moment. Quality, you know, we have a global quality fund. Because of the nature of the screen, basically, if you screen for quality companies, the high return on equity at the moment, you tend to get a lot of technology companies, a lot of consumer discretionary companies, which in the past have been good defensive plays, but they've been a bit hit by the rise in bond yields. So quality, so far at least, hasn't provided the defensive properties that it has provided in previous downturns, because technology has been the area that's been most hit so far in the sell-off. Australia, what's been happening there? Look, banks have been doing okay in terms of relative performance. You can see QFN holding up. Resources have been doing very well on the back of the strength of iron ore prices. Technology, our ATEC ETF, again, as is true globally, remains under considerable downward relative pressure. And as a result, smaller caps have been, you know, underperforming because resources have been doing well, banks have been doing okay. So the big caps have been doing all right relative to the smaller cap growth parts of our market at the moment. But again, I'd be a little bit wary about resources at the moment, given the slowdown. This is maybe starting to look attractive once we get closer to a peak in bond yields, i.e. the growth technology areas. But again, overall, I think that the word of the moment is caution, rather than looking for areas that are going to outperform, because they may outperform, but it may just mean they don't fall by as much as other parts of the market. That's pretty much it from me for now. Have a few minutes left for questions, just under 10 minutes. So hopefully we can take some questions. And again, if you have any more, we can you know, respond via email as per normal.
Yeah, thank you very much for that session, David. I think with all going on in the market at the moment and the global macroeconomic picture, that's some really good food for thought and some really interesting things you brought to light today. We've certainly seen a lot of questions come up about a forthcoming potential recession. I'll get to that in a second. A couple of housekeeping things. So we are running right to time, so apologies for that, just with a couple of audio issues at the start. If anyone does have to duck off, absolutely no problem. We will send around a copy of the recording so you won't miss any questions there. But Dave, we might get stuck into it if that's okay. As I said, a couple of questions coming through on recessions, a few interesting ones. Of the prior recessions, which one looks most similar to today's situation? And from that, if the US does go into a recession, is the expectation that the recession may be shallow?
Yeah, very good question. I mean, that's, and I'll just go back to a slide here that I mentioned before. So, look, if there's any, let me find it. So this is a more of a, if we do go into recession in the US, it's more of a traditional recession where basically the central bank is putting on the brakes to slow the economy because inflation's got out of hand. So it's a central bank demand crunching type recession. It's not a financial market shock like a balance sheet shock. So if you go back to the tech bubble of early 2000, where it was an implosion in the technology sector, we had a bubble in technology stocks, a lot of investment in tech because of Y2K. So that was harder to over, and we had major overvaluation of the equity market. So that took a while to unwind. Obviously, the GFC, where it was banks were had major balance sheet damage to both banks and to households due to the implosion of the housing sector. So they were very deep bear markets. But again, what we're facing at the moment, like there's been no major, credit market upheaval at the moment. It's more of a traditional, 50s, 60s type recession. And so I'm hoping, so as a result, I don't think it's going to be one of the big bad ones of a 50% decline, and it takes many years to recover because it's not a balance sheet type recession. It's more a traditional, dealing with inflation. And in fact, we're in the hands of inflation. If there is an upside risk here, and let me not, if inflation in the US does start to come down quickly over the next few months, I mean, it was only a few weeks ago where we got that May CPI in the US, which was a bit higher than expected. And so the Fed felt the need to go by 75 points. The markets got incredibly aggressive in rate rises. The equity market sold off. If the next few CPIs turn out to be a bit lower than expected, we could at least have a bear market rally. Like the markets could take a lot of relief on that. We'll see. I mean, it's not just enough that inflation will come down. It needs to come down toward the Fed's 2% target by next year. But at least signs of a turning in inflation could give the market some heart. And if it is a quick unwind of inflation, then my projection of a recession and a somewhat deeper equity market downturn won't come to pass. So it is really critically dependent on those the inflation outlook.
Dave, you mentioned the 50s and 60s, maybe looking at the 70s as the case study. Do you expect us to enter a stagflationary environment, as some other commentators have mentioned or mooted? And the flip side of that is there at all a case that inflation at this point in time is transitory?
Is inflation? Look, inflation is as I said before, it's a combination of supply disruption. Russian oil being taken offline. Basically, no one wanting to use Russian oil means that we have less supply of global oil than we would otherwise have. Drought conditions in many countries due to the La Nina. Some climate change related, but we don't need to go into that argument at the moment. So that's clearly a supply disruption. Chinese lockdowns, clearly a supply disruption and the ability of factories to produce the goods and things like semiconductors that the world need. But it is also true that demand is strong, and so central banks are saying, and some people say, oh, you can't deal with it. Why are you raising rates? Because you can't solve the supply problem. That's true, but you can solve the demand problem, and demand is also very strong, and so that's what they're working on. So whether it's transitory, I don't think it's no longer. It's an acknowledgement that demand is a combination of supply and demand. Last year, I think the talk of it being transitory was that they thought the supply chain bottlenecks would ease quickly, and the demand, the move of demand toward goods due to the lockdowns would ease. But we're finding the supply is a lot more intractable, the supply problems, and demand is moderating in goods, but it's still strong. And there's also been a pickup in demand for services. So it's really no longer the debate is, it basically, I think central banks have concluded we need to slow the economy, even at the risk of recession, because if we wait for inflation to fall of its own accord, we may embed it into wage price setting behaviour in the way that we did during the 1970s. And so that's really the situation at the moment. Is that stagflation? Well, there'll be a period where growth is slowing, unemployment is rising in the US, and inflation remains stubbornly high, but coming down at least. So I think it's really not so, it's stagflation I see as a transitionary phase for us going back to a pre-COVID low inflationary world. And it's going to take a period of weaker growth to get us there. And hopefully, a lot of these supply, Russia, Ukraine, I mean, it doesn't look like that's going to end anytime soon. So the supply disruption associated with oil and Russia, hard to see that ending. China's maybe learning that, zero COVID policy doesn't work, because as soon as you reopen again, you get COVID. So there's no, shutting down cities to have zero COVID is no solution. And I think they're sort of working that out. So hopefully that will resolve that issue. Drought conditions, I mean, that's a climate change issue. So again, a lot of these issues are going to persist for a while. But what we can at least do is reduce demand to get inflation back down again through those processes.
Thank you, Dave. That's a great answer. You mentioned oil. Just quickly, do you have a view on the oil price medium to long term?
Look, I think what we're seeing is the oil is creating demand destruction at the moment. So oil could easily go higher. I mean, my base case is that oil is peaking and it's going to come back down to $100. But so that's still going to be high. But at least the rate of inflation due to energy is going to moderate. Because we're going to see a peaking of oil. But why are we seeing a peaking of oil? Because the demand is slowing. So it's because of the slowdown and the recession in the US, which is going to bring oil down. So again, it goes back to the fact that we need to get demand down to get oil down, given the supply constraints there.
And maybe shifting just to back home or Australia, property prices, there's a few questions there. Are we going to see that dampen in 2023, just given that post-COVID pent-up demand coming off with rate rises?
Yeah, look, I wouldn't quibble. I mean, I've been on record saying that I think house prices are going to fall by 10, possibly 15% nationally over the next 2 years on the back of the RBA renormalising interest rates. I don't think you need, a big increase in rates to do that. I mean, mortgage affordability, even before the RBA started raising rates, wasn't great. It was basically a little bit, mortgage unaffordability, let's say, was a little bit above long-run average levels, even before the RBA began raising rates, because of the sheer strength of house prices. House prices nationally were up 25% since COVID, and so affordability got crushed. And again, even if the RBA wasn't raising interest rates, I think you would start to see a leveling out of Sydney and Melbourne prices, simply because no one could afford to pay any more easily. But the fact that the RBA is raising rates, prices will come off. But we've had house price corrections in the past. I think nationally up to say 8%. So some people are saying 20, 30. It ultimately depends. If you think the RBA is going to raise rates to 4% or more because we're going to have a major inflation problem and cause the economy to go into recession, then yes, house prices can fall 20 to 30%. But I'm not calling a recession in the US. I'm not calling the RBA raising rates to 4%. I think they're going to go to 2.5%, possibly 3%, but I think 2.5% might be the limit, because again, we're already seeing consumer confidence unwind, even with the RBA raising rates to not even 1% yet. So as a result, I think the house price declines are going to be limited to 10, possibly 15%.
Great, and you answered another question there, just in terms of where you see rates heading here. A couple of questions on gold and currency and commodities in general. USD seems to be preferred to gold as a safe haven, was a question. The follow-up was, can we buy USD ETF, a US dollar? So you can, the ticker code for that is USD. But Dave, any commentary there?
Yeah, so gold ordinarily in a period of high inflation, you would think would rally. I mean, back in the 70s, gold rallied, but I think the difference here is we do have central banks that are learning the lessons, although they say they're learning the lessons of the 70s, and they are not going to let inflation break out in a sustained way in the way that it did in the 70s. So aggressive interest rate increases, so aggressive move higher in bond yields, aggressive move higher in the US dollar is capping gold prices. And so that's what's limiting gold. Gold has actually done better than bonds since last year. So if you wanted a defensive asset late last year and you had a choice between bonds and gold, gold would have been the better option, because at least it hasn't lost as much value as bonds have done since late last year. But going forward, I haven't been super bullish on gold, because I do think central banks will act to rein in inflation and jack up rates. Being bullish on the US dollar and bearish on the Aussie. And again, I think if we go in a global downturn, US dollar could continue to strengthen, Aussie dollar can weaken. And if you wanted to take a position on that, yes, we do have some currency ETFs that give you that exposure, USD, for example, to get exposure to basically invest in the US dollar strengthening vis-a-vis the Australian dollar.
Great. And just any commentary on commodities, iron ore, copper, and their performance if we do get a recession in an inflationary environment?
Well, I mean, it's leads and lags. I mean, look, they've done well because, look, inflation's picked up. Inflation's picked up because demand has been strong, supply shortages, and so commodity prices have gone up. Commodity prices have gone up, which has pushed up inflation. But as central banks now throttle back demand to deal with high inflation, then commodity prices have got to come back again. So that's the that's the challenge in this environment. It's hard to be ongoing bullish about commodity prices when you're getting central banks directly targeting reductions in demand to bring commodity prices and down again. Now, you may get this push-pull factor where, because of supply, commodity prices go higher in the short run, which is, that's going to be a stagflationary environment. So take oil, for example. If further disruptions cause oil to go up to $150 a ton, not drop back, a barrel, $150, that's going to be a massive shock to the global economy, probably cause central banks to want to raise rates even more. To limit the flow through to broader inflation. And so that's a stagflation environment. Inflation will go higher and growth will be weaker, but ultimately that demand destruction will then, push down oil prices. But iron ore prices, look, it really comes down to China. China's going to reopen. I mean, one of the, upside inflation risks is that China has been in lockdown, which has added to supply side disruptions. Now, as China come out of lockdown, those supply side disruptions will ease. But you know what? China's demand itself will start to pick up. So China's demand for energy will start to increase. China's demand for iron ore will also start to increase. And so that could put up prices. Now, then the question is, what does China do with that? So think about China, and think about iron ore specifically. They don't want to rely on steel production. China's producing too much steel. It's causing pollution. It's causing debt problems. But they at the same time, they don't want their economy to be too weak. So they're caught in this this juggling act where on the one hand they want to slow the economy, rein in steel production, and then iron ore prices weaken, and then if they worry too much about the economy slowing, they ease credit conditions again, and steel production goes up. So although they've talked the talk, when push comes to shove, they've still tended to allow steel production to remain at high levels. So we'll see how that plays out in the second half of the year. It's really up to China whether it does want to tolerate steel production remaining at what does seem to be unsustainably high levels.
Right, and Dave, I think we've got time for one more, two parts to it. So are there any safe suggested funds for an ethical focus? I can talk to that, but Dave, maybe in the meantime, after I tackle that, just in terms of sustainability, decarbonisation and that ethical theme, just any comments on the performance there going forward in this environment? So just to touch on what we have available, Fair TAN, which is a new solar ETF, TANN, and Earth, ERTH, are the equity side investments that we have in the sustainability space. And on the fixed income side, GBND. But Dave, any commentary just on those going forward?
Yeah, it's been, I like in the headline I saw the other day, the revenge of the old economy, because, a year or so ago, no one wanted to touch traditional energy. Everyone, coal was out, oil was out, and no one wanted to invest in energy companies, traditional energy companies, new energy, clean energy, a lot of our ethical exposures as well, which have a sort of energy focus, we're doing very, very well. Now we've had the rise in interest rates, the supply shortages, energy shortages, and who would have thought 2 years ago that the energy sector globally has been the strongest performing for the past year. Now the ethical and alternative, the sort of cleaner energy funds that we have, one of the issues is that a lot of them, that just because of the nature of the companies that they include, they tend to be technology companies, high technology companies. Our ethical funds, by definition, strip out fossil fuel producers, and so given fossil fuel producers have done so well, given the strength of oil prices, the ethical funds relative to global markets haven't done as well because they've stripped out those companies. Plus, a lot of the a lot of these companies also tend to be tech related, tech companies. And if I go in,
seems we may have lost David there. So in the interest of time, I think he was pretty much done with that question anyway. Thank you all for your attendance today. Much appreciated. And we'll send a copy of the slides and a recording of the session today around. But that ends the formalities for today, and thank you very much for your time.